What if I told you that the most important buyer in the silver market has been absent for an entire week and returns on Monday morning? What if the violent move from $79 to $84 was not the event, but the warning shot? And what if the market right now is pricing silver as if nothing structural has changed, while the largest physical demand engine on the planet is about to switch back on? Stay with me carefully because what I'm about to explain is not hype, it is positioning. And positioning is what separates those who react from those who prepare. This is shadow economics. For the past several sessions, silver has behaved like a battlefield. We watched it drop aggressively into the high 70s. We saw coordinated selling pressure hit the futures market. We saw volatility designed to shake conviction. And then we saw something that does not happen in weak markets. We saw absorption. We saw buyers step in with force. We saw a complete reversal that trapped anyone who thought the breakdown was real. Silver did not stabilize quietly. It did not crawl back. It snapped back with authority and closed firmly in the mid-80s. That alone should have your attention. But here's the part most people are missing. The rebound happened while China was offline. Let that sink in. The Shanghai exchanges have been closed for Lunar New Year. Industrial procurement desks in Asia have not been active. State-linked buyers, manufacturing hedgers, strategic reserve managers, absent. The largest physical consumer ecosystem in the world was not participating in price discovery. And yet silver absorbed a multi-dollar flush and reversed violently higher without them. So the real question is not what happened last week. The real question is what happens when China logs back in. China is not a speculative silver buyer. It is a structural buyer. Solar manufacturing alone consumes massive quantities of silver. Electric vehicle production uses silver in electronics and battery systems. Advanced industrial equipment, telecommunications hardware, semiconductor infrastructure. Silver is not optional in these supply chains. It is required. And when you run the manufacturing engine of 1.4 billion people, your demand is not emotional. It is calculated. It is persistent. It is price aware, but not price fragile. Now think about the timing. China returns to open markets at a moment when silver has already proven that sub-80 pricing cannot hold under stress. The recent dip created a psychological reference point. Anyone who needed silver and hesitated now sees the chart and understands something very clearly. The window for cheap accumulation may already be closing. Markets are not just driven by fundamentals. They are driven by memory. The memory of a failed breakdown is powerful. When an asset refuses to stay down, institutions notice. And here is where it becomes strategic. Western futures markets are heavily paper-driven. Contracts trade in volumes that dwarf available physical supply. But when physical demand accelerates, the paper price becomes vulnerable because futures contracts ultimately settle against real metal in delivery windows. If too many participants demand physical instead of rolling contracts forward, inventory stress begins. Registered silver inventories in major vault systems have already been declining over time. The ratio between open interest and available registered ounces has tightened. This does not cause panic in normal conditions, but it changes the math when demand surges unexpectedly. Now add geopolitics to this equation. Energy markets are tense. The Middle East remains a pressure point. Oil volatility has direct inflation implications. Inflation pressure changes central bank behavior, and central bank behavior influences currency confidence. When currency confidence weakens, hard assets strengthen. Silver and gold do not exist in isolation. They exist in a web of global trust dynamics. China understands this better than most. China has been actively diversifying reserves. It has increased gold purchases consistently over recent years. It has reduced reliance on dollar-denominated assets gradually. Silver, while more industrial, fits into a broader strategy of securing physical inputs necessary for economic continuity. When uncertainty rises globally, strategic economies do not wait for perfect prices. They secure supply. So imagine Monday morning. Shanghai reopens. Procurement algorithms activate. Industrial hedgers assess forward needs. Strategic desks evaluate current price versus potential volatility ahead. They look at the recent chart and see strength, not weakness. They see a failed suppression. They see a market that could run if physical tightness increases. Do they wait or do they act? History suggests they act. And here is why this matters for the $90 level specifically. Round numbers are psychological magnets. 80 was defended. 85 is now structural support. 90 becomes the next visible threshold. If Chinese demand adds even moderate incremental buying pressure into an already tight structure, momentum traders join. When momentum joins physical demand, price accelerates. This is how markets move from consolidation to breakout. But let's go deeper. A short squeeze environment does not require retail frenzy. It requires trapped positioning. The recent flush into the high 70s invited short sellers. Anyone who believed the breakdown narrative likely entered positions expecting continuation lower. When price reversed, those positions immediately went underwater. As silver pushes higher, their risk increases. If price approaches 88 or 89, margin pressure intensifies. Forced covering adds fuel. Now combine forced short covering with renewed physical demand from China. That is not noise. That is structural ignition. Some will argue that global demand may slow due to economic uncertainty. That is partially valid in consumer cycles. But silver's industrial demand in China is tied to long-term infrastructure, green energy initiatives, and export manufacturing commitments. These are not overnight projects. They are multi-year strategies backed by policy, which means baseline demand does not disappear during volatility. It often increases because securing supply during instability becomes priority. There is another layer few are discussing: currency dynamics. If the dollar weakens even marginally due to shifting interest rate expectations or geopolitical risk repricing, commodities priced in dollars naturally gain tailwinds. China transacting in local currency equivalents benefits when dollar strength pauses. Timing matters, and timing right now is delicate. So here we are, silver sitting in the mid-80s, a failed breakdown behind us, a delivery cycle ahead, geopolitical tensions simmering, China about to re-enter the arena. Ask yourself honestly, does this look like a market ready to collapse? Or does it look like a market compressing before expansion? Price action tells truth before headlines do. The market attempted to trade lower. It was rejected, strongly. That rejection matters more than the drop itself. The next 48 hours are not about fear. They are about observation. Watch Asian session volume. Watch how price behaves during Shanghai hours. Watch whether dips are shallow and quickly bought. That will tell you everything about underlying demand strength. If silver trades firm during Asian hours and holds gains into Western sessions, the probability of testing 90 increases dramatically. If it surges aggressively on open, short covering could amplify the move. But understand this clearly. $90 is not a magical ceiling. It is simply a milestone. If broken decisively, it resets expectations. Markets reprice in stair steps. 80 was defended, 85 reclaimed, 90 tested. Then the conversation shifts. This is not about predicting exact intraday ticks. It is about recognizing structural setups before they resolve. China returning is not a headline event. It is a liquidity event. Liquidity returning to one side of the market changes balance. When that liquidity is tied to physical necessity, not speculation, it carries weight. The last time silver showed similar resilience under pressure, follow-through buying expanded the move over subsequent sessions. Markets remember stress tests. Assets that survive them often trend. Now I want you to consider the psychological component. Retail traders often react to the move that already happened. Institutions prepare for the move that might happen next. Right now, most retail participants are debating whether 84 is expensive relative to 79. Institutions are debating whether 84 is cheap relative to 100. Perspective defines positioning, and that is why Monday matters. Not because of drama, not because of fear, but because a major demand participant re-enters at a structurally sensitive price zone. If price pushes into the high 80s quickly, headlines will follow. Analysts will scramble to explain. But those watching now will understand that the move began before the explanation. Silver is not just a metal, it is a signal. It signals inflation pressure. It signals currency stress. It signals industrial expansion. And when multiple signals align, momentum builds. Could volatility continue? Absolutely. Markets never move in straight lines, but failed breakdowns often precede upside resolution. Shadow economics exists to decode these transitions before they are obvious. So here is what matters over the next sessions. Does physical demand show up in size? Do pullbacks get absorbed quickly? Does volume expand on upside breaks? Does 90 become magnetized? If the answer to those questions is yes, then the move from 79 to 84 was only phase one. The real acceleration begins when structural demand meets trapped positioning. And that intersection is closer than most realize. China is back. The market is not fully priced for it. Watch carefully, because if silver prints 90 sooner than expected, the conversation changes overnight. This is not about panic. It is about preparation. The opportunity is not in chasing spikes. It is in understanding setups before they resolve. Monday is not just another open. It is a liquidity return event in a market already proving strength. And strength under pressure is the most important signal of all. This is shadow economics. If you found clarity in this breakdown, make sure you are positioned with awareness, not emotion. The market does not reward reaction. It rewards preparation. China reopens. Silver stands firm, and the next chapter begins.